Well, despite a seeming lack of conviction in this shortened trading week, the PSE has managed to keep itself afloat above 7,800. But markets aren't bereft of risks, both local and foreign, to deal with. Well, Phillip Hagedorn, the president of ATR Asset Management, joins us on the last trading day of this week to give us his thoughts on where markets might be headed. Phillip, again, always a pleasure to have you here. And the PSE has managed to sustain this recent breach of 7,800 come rain or shine. And mind you, it's also doing it in the midst of Ghost Month when not much is expected of the local bourse. Does this stubbornness from the traders on the PSE surprise you, or is there something? Was this always a possibility, despite the fact that we're in Ghost Month, for the PSE to be this resilient and stubborn?
Yeah, well, good to be here. I think we're trading within this expected range that we felt 75 to 7,800 would be the range post earnings season. I think the big test was actually whether we would hold above 7,500, maybe as early as even last week, when we saw a lot of news about Turkey and Philippines being compared to that potential catastrophe.
Right.
But we held very well.
Was the contagion overblown, do you think?
I think very much so.
Yeah.
So we held very well. We tested 7,500. We're now at the top of the range. I don't think we'll be breaking out of this range anytime soon. I think we have a few more weeks, maybe a couple more months of sort of consolidation. But we're encouraged, particularly because of earnings after the second half.
And what was your impression of earnings season? It's pretty much all wrapped up already for the second quarter. Your impressions, and were there any sectors that surprised you or possibly also disappointed you for top and bottom?
Well, let's try to break it down, right?
Okay.
We had an outlook of about 10% earnings growth this year. The first quarter came in at 9.8. The second quarter actually came in right around 9.7, 9.8 as well. Although it's not the mix that we expected.
Right.
So I think where the underperformance came from was from the banks primarily. And where the outperformance came from, I think, were telcos and the property companies.
All right.
So that we're still getting to the number.
What surprised you about the mix, exactly?
Well, I think the banks, I think what we're looking at for the banks is that the impact of sort of mark-to-market and new accounting rules was much larger than we expected. So loan growth is good. NIM expansion is there, although not as aggressive as we expected it to be. But these changes in rules, especially with the stock market down, has impacted the P&L. So we'll see if the market recovers in the second half. That might reverse, but the absolute earnings number was just in the low single digits, where we expected it maybe double digit, 10%, 11%.
All right. Now, going into the banks also, we do know that two of the biggest banks in the country, BPI and Security Bank, have both issued dollar-denominated bonds. Recently, BPI issued about $600 million for that. Very successful. Security Bank gearing up for $1 billion. Here's the thing, though. The dollar index, or the greenback, is seen to get stronger and stronger as we go. They're also pegging this against U.S. tenors as well, and you see the rates also in the U.S. starting to rise. Is this a smart time to do this, or are they really going to be forced to do this because of possible demand for dollar-denominated instruments here?
I think it's good to have a bit of a mix. I don't think it's at levels where it's a concern when you compare the foreign debt exposure to the local debt exposure. So on balance, still okay, but we do expect the peso to continue to weaken. So probably over the next 12 to 18 months. I don't expect a massive depreciation. So we're kind of gauging 54 and maybe a little higher than that next year. So that shouldn't impact them that negatively. But that's something we're really expecting. We have a trade imbalance that's not likely to get corrected anytime soon.
Right.
And so we could expect the peso to get into the 54s early next year.
But given current leverage ratios across the sectors, banks, property, stocks, are they positioned to handle perhaps a higher forex risk and perhaps and maybe take on the higher levels of dollar-denominated debt? I
think last numbers that I saw, we're still at around 20% of GDP versus, I think, back in the crisis days, closer to 60, 70%. So we're very under leveraged compared to when we had problems.
We're a lot smarter now, I take it.
I hope so. But it's something we have to watch out for. And I don't, some companies, again, it's about the balance. And if some companies have a significant amount of foreign debt, that's something we would worry about. At this point, I don't think there's anyone flagging that problem at this
All right.
point.
Let's go into the property sector. You did say that this was one of the outperformers. And were you surprised about how well they did? Because when you look at across the board from the top, from the big four, all the way down to the midliners, it was like they were competing as to who could get a bigger jump in terms of profit growth. I mean, was this surprising to you, especially given the interest rate environment here is starting to tighten up a bit?
Yeah, what we continue to expect to be strong is demand for housing. So I think on the resi side, residential, that didn't really surprise the market. We did expect sales to be strong. Although rates have moved up, the mortgage rates haven't really, they're not really that low compared to global levels yet. So there's still some room, I think, for the banks to extend some of those loans out at rates of this year or maybe not last year, but this year. The area that surprised, I think, was the office space. And that was an area that we felt might start to get weaker. There are concerns about BPO expansion. But then suddenly you had this advent of the POGO business. That seems to be in question now, whether that can continue to grow as quickly as it has.
I was going to bring that up, actually, because we look at the POGOs. There was this report that there was a crackdown on certain online gaming activities, operations in China that were linked to a Philippine website or Philippine POGO. I mean, could this actually, if we do see a slowdown in POGOs, who might get most affected? And do you think they have contingency plans in place if this does happen?
Well, the other side of the coin I was about to say was that the demand from just regular business is growing as well. Okay. So, we might just be lucky where, we had the slowdown in BPOs, the POGOs came in. If the POGOs start to slow down, it looks like there's some demand from corporate world again. So at this point, obviously, I think if you look at the big three developers, SM, Prime, Ali, and MegaWorld probably has the most exposure to the office space sector. Or at least the mix that they have is more leaning towards that office space sector. So the risk would be probably on that front.
All right. Speaking of rates, property stocks, we also want to look at where global monetary policy is trending. I want to bring up this chart, Philip, to show viewers the odds of a September rate hike from the Federal Reserve at about 94.6% at the moment. It's pretty much almost a near certainty, but do you think emerging markets like the PSE have priced in this probability, or do you think they're ready for possibly more tightening from the Fed if Jerome Powell decides that, we can probably tighten the screws a bit more?
My sense is that this move is probably priced in. What's very uncertain, I think, is next year. Because if you listen to the Fed's rhetoric, we're expecting maybe 4 more hikes next year. But there is some talk now of slowdown in the U.S. You're hearing recession talk more and more. Maybe just warning at this point, but I think it's very hard to call next year and how many hikes we'll have next year. So it looks like the hike pace might be easing a bit, which is understandable because we've had a very aggressive pace in the last 2 years, maybe. But next year is still a big question mark. And actually, that's where I see the headwinds for the Philippines coming. It's not locally, it's really offshore.
No, the two scenarios, you can look at it in two ways, right? If the Fed decides to ease off on hiking because of concerns about the U.S. economy, it could see funds coming back to emerging markets. But if the U.S. economy slows down or even hits a recession, this could also trigger a bit of panic. Where do we find the balance between these two particular scenarios if it plays out this way?
Yeah, it's going to be very interesting. But I think, first of all, you don't want the U.S. to slow down too much, right? I think that's still the engine of growth. And as long as the U.S. is growing, people can piggyback off of that growth. So calibrating what they do in the U.S. and how they manage, they seem to be at a GDP pace that's much higher than their potential. And that brings out concern. So what they do over the next few quarters to see how they can manage that is going to be important. I don't think they're going to want to slam on the brakes either. So I expect it slower growth, but still growth and still acceptable in the general expectation of what you think the U.S. can grow at. And I think that'll be positive for the rest of the world because there are growth problems in Europe, in Asia. China seems to be slowing down as well. So if the U.S. can still be that engine, then any slowdown will be mitigated a little bit. And I think the focus can come back on internal factors. And if that's the case, then I think our headwinds have eased a lot. And I think we have probably 12 to 18 months of leeway where, we can see some growth, some earnings come back, some less talk on politics and more talk on fixing the economy and getting the infra projects going on.
Do you think political risk is already making itself more prominent in the conversation as to where the headwinds of the Philippine markets are? It's generally been tiptoed around. They've basically said it's more macro issues such as inflation and whatnot. Do you think political risk is starting to factor, especially when you take into account that foreign funds haven't been exactly that convincing yet with their return to Philippine markets?
Well, I think just even as much early as 2 weeks ago, the risk on especially federalism being, accelerated was high. But I think over the last 2 weeks, things have changed pretty dramatically. And
for the better or worse?
In my view, for the better, where the conversation is going to be drawn out longer. Let's have a better think about this. It's not a bad idea, but it's a bad idea to do it, tomorrow.
Right.
And so, I think that conversation is a good one in my view. And I think, that the shift away from that distraction and focusing on challenges that we have on the ground today, the build programs, getting that infra program going, our agri sector. And, if you think about inflation this year, that really is a culprit in my view. So, we have to focus on these matters that are much more pressing and much more impact in the short term.
In fact, they made themselves felt in the second quarter. GDP figures came in at about 6%. Or do you think the odds of the Philippines making a comeback in the second half are decent?
We've had a great debate yesterday in our office on this and where GDP and what's the drivers. And it seems like the main drivers today is capital formation, which continues to be strong, and we'll expect the spending to come in. But then the imbalance of imports and exports is what's kind of dragging things down a little bit. And unfortunately, that's going to continue if we continue to build. So the question is 6% growth bad? And the answer is no, absolutely not. As a matter of fact, when you talk about 6.8% growth, people say we're going to overheat, got to get out of the market. Now we're saying 6% is too slow. So you're never going to get everybody happy, right? My view is above 6% growth sustainable is what's sustainable. Once you get above 7, at this point, the economy is just not there. The capacity to support the building is not there. So what we can expect is 6 to 6.5% growth is a very sustainable level. And that's very good. And I think, that's what we expect to see. We might see a 7.2, but to me, that's also not realistic and not sustainable over the long term. So at this point,
so no reason to panic if we see 6% to 6.5% from the economy. And so far, markets at least looking for just a little bit more clarity on some of these headwinds as well.
I think I think the skies are clearing up a little bit. The rainy season's maybe getting behind us. We look forward to the Amihan winds to fill our sails.
Well, here's to hoping that the Burmans treat us better then. Phil Hagedorn from ATR Asset Management, thanks for joining us this morning and sharing with us your insights on this last trading day of the week.